Trader vs investor in stock market. The stock market attracts a diverse group of participants, including traders and investors. While the two may seem similar at first glance, they differ in their approach, objectives, and methods of participating in the market. Traders aim to make short-term profits by buying and selling securities quickly, often within the same day. They are concerned with short-term price movements and seek to capitalize on market volatility. Traders often use technical analysis to make decisions and have a higher risk tolerance. They may use margin, leverage, and other trading tools to increase their potential profits. Example: a day trader buys shares of a stock in the morning, following a bullish trend in the market, and sells the same shares in the afternoon when the stock price rises. The day trader seeks to make a quick profit from the price difference and does not hold the stock overnight. Investors, on the other hand, focus on the long-term growth of their portfolios. They buy and hold securities for an extended period, often several years or more, in order to benefit from the growth and appreciation of the underlying assets. Investors typically use fundamental analysis to make investment decisions and have a lower risk tolerance. They may also diversify their portfolios to reduce risk. Example: an investor purchases shares of a blue-chip company with a strong track record of steady earnings and revenue growth. The investor holds the stock for several years, receiving dividends and capital appreciation, with the goal of long-term growth and income. Key differences. 1. Time horizon. Traders focus on short-term price movements, while investors focus on long-term growth. 2. Risk tolerance. Traders have a higher risk tolerance and are comfortable with short-term price volatility, while investors have a lower risk tolerance and prefer stability. 3. Method of analysis. Traders often use technical analysis to make decisions, while investors typically use fundamental analysis. 4. Holding period. Traders aim to buy and sell securities quickly, while investors buy and hold securities for an extended period. 5. Investment goals. Traders aim to make short-term profits, while investors aim for long-term growth and income. It's important to note that individuals can adopt elements of both approaches and take a hybrid approach to participating in the stock market. For example, a trader may also hold a portion of their portfolio as a long-term investment, and an investor may also engage in short-term trading. In conclusion, traders and investors approach the stock market with different objectives, methods, and risk tolerances. Understanding the key differences between the two can help individuals make informed decisions about their investment strategies and approach to participating in the market. Please like, subscribe and share our videos.